Hi everyone, I'm Chad Shoop and welcome to this week's edition of Bank It or Tank It. And I'm really excited about the video today because it's not a stock that I actually had to go and find myself, but it's a stock one of you all recommended. So big thanks to John Klimchek, and I hope I pronounced that right, but big thanks to John for writing in. He said, please comment on Cisco, CSCO. So that's the stock that we are going to take a look at today in our Bank It or Tank It. So just like John's stock got picked for today's video, any of those other stocks are going to be picked in the coming weeks, and you can leave me a comment below this video as well, and just when the timing is right, I'll feature those stocks in an upcoming Bank It or Tank It, and I'm going to find a way to incorporate every stock that you all comment on in my videos so that way I can give my quick takes on how I feel about certain stocks, even if it's not worth recording a full Bank It or Tank It video on. So just scroll below, leave me a comment with the stocks that you want me to take a look at, and I'll be sure to include them in the coming weeks. So if you haven't yet, scroll right below this video and click subscribe. It'll take 2 seconds and it doesn't take you away from the video. You just click subscribe so that way you don't miss out on any of my weekly Bank It or Tank It videos or any of my stock market updates that I post to YouTube. And you can click the bell. Once you're subscribed, you click the bell. That way you get a notification every time I post a new video. So today we're going to be taking a look at Cisco, and we're going to break down everything from its fundamentals to its sentiment to the technicals, and it's all for one reason. We want to figure out whether or not this is a stock that we want to bank on going higher or it's going to tank and head lower. So we're going to dive into this stock today, and we're going to start with the key stats. This is a chart we look at each week with the stocks that we cover in Bank It or Tank It because revenues and income are two of the most important items for a company. We want to see whether those are growing or declining as part of the fundamental analysis that we want to look at. So on this chart, the blue line is the total revenue, and on the left side is the metric for that. So we can see that revenue took a dip in 2017 and then a major dip in 2018, but it bounced back in 2019, which is great to see, and they're expecting a steady climb over the next 3 years. But when we look at net income, it was almost in the negative in 2018. So they really struggled generating bottom line profits for the corporation, but you can see that turned around in 2019, and you can see the bars steadily climb throughout the last 3 years as well, 2020, 2021, and 2022. So we see that analysts are pretty bullish on this, and we can go take a look at what the analyst expectations are real quick. And you can see that they're rated an outperform with a 2.03 rating, and this is out of 27 analysts that are covered in S&P Capital IQ's platform. So we can see that the sentiment for this stock is starting to trend in the right direction. And when you look at what's going on in the news right now for Cisco, they're going through a transformational shift for the corporation. If you don't know, Cisco's the company that's behind a lot of the connectivity that we see with the internet, but we don't really see Cisco up front. They're in the routers, they're in networks, they're in switches, they're in all these different devices that help provide the internet to data centers, to our smartphones, to our homes, and to our businesses. Cisco's kind of behind the scenes for all these places, but they've been losing market share. There's been a lot of competition in the recent years. So they're a large developed corporation, but they're facing an uphill battle with some of these smaller competitions that are coming in, doing things a little bit differently and stealing market share. So now Cisco's having to turn around and battle those companies. And they recently, just last week, announced that they're going to produce their own chips. Now, this is a big move because they've been making chips, but Cisco has really been known for producing their routers and their other products. Basically, you can only buy Cisco products, and it's made with everything from Cisco. But Cisco hasn't outsourced those other smaller products like the chips that other companies can use to build similar products, but that Cisco can still get their chips in to still generate some revenue. Because when you look at the data centers, that's been one explosive growth opportunity that Cisco's really missed out of. Amazon, Google, the large data center providers, they really went and insourced and created their own chips that they can use for this and went outside of the large tech Cisco to supply their data centers. And that's really part of the initiative that Cisco is trying to see. They're trying to re-innovate their brand and stay relevant in this market, because as we dive into the key comps and we look at where Cisco stands amongst some of its competitors, you're going to see that they're definitely the larger stock here, they're a larger corporation, but their growth has really slowed down. So let's dive into that and we'll take a look and you'll see what I'm talking about. So this is another tool in Capital IQ where I just pull up quick comps and it throws out 10 of its closest competitors based on a few different analysis that they run. And now we compare that to Cisco. And you can see how the individual companies do here, but I really like to focus on just Cisco in the mean and compare it to these key competitors. So the first one's market cap, and you can just use that to see how large of a stock Cisco really is. Its market cap is $193 billion compared to the mean, which is just under 10 billion. So this is a huge company in this industry, and this reflects that they are a large cap stock in this holding. But all these smaller companies are really stealing market share and really having to shift the way Cisco likes to do business. Now, when you look at short interest, this is a little deceiving because with Cisco being the larger stock, it's going to have more shares out there on the market. So this short interest is just number of shares. So while they have the larger short interest, it still shows that there's a lot of people looking to short this stock, even though it's not a direct percentage of how many shares are sold short. It just tells you that a lot of people are really betting that this stock will decline. And the main reason for that is because it's this old technology versus new technology where these younger companies are coming up, but Cisco's kind of the one that's having to try to re-innovate itself to stay relevant in this market, and that's why we see that company with a large short interest. Now the PE ratios for Cisco is at 18.2 times earnings is where the stock's trading. You can see the mean's higher than that. It's at 24.2 times, and when you look at these companies, you see several of them just have NM, NM, NM. That's really because they don't have any profits at the moment, so there's no earnings to times by to get to where the stock is currently trading at. So these are companies that are losing money, so they're going to have very high PE ratios, and then the rest of them are all above 20, which are all above where Cisco is currently sitting at. And that's really just factoring in their growth, because when you move over to the next column and we'll look at the total revenue, the 3-year compound annual growth rate, and the net income 3-year compound annual growth rate. And when you look at Cisco versus the mean on those, Cisco's at just 2.1% for revenues and 1.14% for net income. And the mean is sitting in double digits for revenues and over 30% for net income. So it really reflects that these other companies are seeing much stronger growth. I mean, they're smaller companies, so you would expect that, but it's showing that Cisco is really struggling to tap into this growth and in turn are losing market share to these other companies. And that's why the stock's having to go through this transitional period where they're trying to find a new way to generate revenue and income to boost their bottom line. And then this is a new column I have for this week because it really sticks out for this stock, and that's the dividend yield. And Cisco pays a 3.1% dividend yield, which is, you can see on the mean there, it's actually below the mean. So some of these other stocks that stand out are Nokia, 6.2%. That's really pushed the mean up. Then Juniper's at 3.1%, and then Plantronics, 2.5%, and Motorola at 1.6%. But I always like to dive a little further into stats like this. So I'm going to pull up a chart about Cisco's dividend to make a point real quick. Now on this chart, it just shows the dividends per share that Cisco has paid since 2011, which is when they began paying a dividend, till now, till 2019. And what you want to see on this chart is a steady climb, because what that shows you is that this wasn't a one-off dividend, and it's not a company that doesn't know what they're doing with their dividend. They're not increasing it one year, then having to decrease it the next year because the revenues are just simply not there to support the dividend. Instead, Cisco's been able to manage their dividend, consistently increase it over the years, and this really reflects greatly on the leadership of the company. It shows that they know what they're doing, that they've been able to manage this dividend to over 3% yield. Now, I wouldn't recommend owning Cisco just for the dividend, because if your goal is actually to generate income in the market, I don't really recommend dividend stocks. I know that's the usual approach, that if you're trying to generate income, looking for steady income, they recommend dividend stocks. But everybody forgets that if you own a stock, the most important part is price, not its dividend yield, not its PE ratio, it's price. And if price is declining or rising, that's really where you're going to make your money, because 3.1% a year may sound like a lot. It sounds like a great dividend yield, but the stock drops 10% that year, then you just really got crushed on what you actually have in the bank and have in the stock. So that's really not a great approach if your single goal is to generate income. Instead, I have a more unique approach that I love to implement each and every month that steadily generates double-digit yields from the stock market. So if you want to learn about that, you want to learn about how I generate income in the stock market, that we are still able to generate much more consistent yields, high yields, double-digit yields each and every year, then scroll below this video and I'll have a link that'll help explain everything about it. So just be sure to check that out if you're interested in generating income in the stock market. And one other reason that makes Cisco interesting here at this level is also about its income, and it's because of a phenomenon known as the dogs of the Dow. If you haven't heard of that, all you do, the Dow Jones Industrial Average has 30 stocks. Each year you take the 10 highest yielding stocks and you buy them and expect to outperform in the next year. And the idea behind it is that if these stocks that have higher yields, and Cisco is actually the ninth stock on the list right now, that could change by the end of the year, but right now it's the ninth stock out of those bottom 10. But what you expect to see is that with the higher yields, you expect the price to rise. For one, if it doesn't rise, you're getting the higher yield, but you expect the price to rise because to make that yields higher, price and yield are inverted. So as price declines, yield rises if the dividend stays the same. And as price rises, the dividend yield falls as long as the dividend payment stays the same. So price is kind of the key factor. And when you look at the highest yielding stocks, they tend to be stocks that struggled in the last year. And Cisco is one of those. As we looked at the price chart, you'll see how Cisco has not really benefited as well as the broader markets over 2019. So it has a higher yield and ended up as being one of the dogs of the Dow. And I have an article about this in the coming weeks that I'll dive more into it. But the bottom line is that we expect Cisco to outperform the stock market in 2020 simply based on that factor of its dividend yield and where it ranks in the Dow Jones Industrial Average. So that's something to keep in mind. And now it's time to get to my favorite part, the technicals of the stock. So let's take a look at its price chart. So once again, I have a few of the familiar key lines pulled up that we want to take a look at. And we'll start with the 200-day simple moving average. I've talked about this before, but it's just to help us have an understanding of the trend for the stock. When this is rising and the stock price is above it, that's bullish and prices are headed higher. When it's declining, which we can see it's starting to do now, and prices are below it, that's bearish. And we're going to talk about that today. But I think that this 200-day moving average is going to be a key level for Cisco as we move forward. Then I have this solid green line on the bottom, and this is the major support for the stock. This is, if you're bullish on a stock or if you want to turn bearish, this is going to be the key level to watch, because once it gets broke, then you can look for the stock plummet much, much further lower. But until it's broke, it's going to be holding up the stock, and it's going to be hard to be bearish on a stock as long as this key support line's in place. But now, as we zoom into what's happening recently, we have this little consolidation pattern here over the last few months. But then prices broke out to the downside. That was bearish. This is a green dotted support line, a red dotted resistance line. But when prices broke below the support line, then that support acted as resistance, which you can see here. And just last week, it came up and tested this again. So it's failed to break above this old support, which has turned to a resistance level so far. But actually, I expect to see prices break through this key level, because when we look at the RRG lines on a chart, that's relative rotation graph, and we look at what they're showing us, and it's showing an oversold indicator on those lines, which tells us that in the short term, this is just days, that we can expect this uptrend to continue at least for a few days. It may not get all the way back up to the red resistance line, but I think it's going to break through this green trend line here, at least in the short term. And what we could see over the next few weeks, and that's still considered short term, but is a push up here above maybe even this red resistance line that we're seeing here. But the key one to watch is going to be the 200-day moving average. I don't think Cisco is going to break out above that. I think that these two factors right here are going to be enough to push shares lower in the coming weeks. And the fact that it already broke out to the bottom of this recent consolidation pattern was bearish as well. But it's going to be extremely hard to turn bearish on a stock until it breaks below the green support line. Until that happens, we can see the stock bounce back and forth between the green support and a falling 200-day moving average here for a few months before it eventually breaks out and gives us a clear signal of where the stock will be headed for months after that. All right, so now that we ran through everything, looking at a bunch of different factors for the stock, it's time to pull up a checklist on Cisco and run through how it ranked for our key areas that we looked at today. And when it came to fundamentals, Cisco is going to get a big check, because if not only just for its dividend yield and how it's going to be implemented in the dogs of the Dow, but because it's a large cap stock, had a fairly low price to earnings ratio, and it's still seeing some revenue and income growth. It's just really going through that transitional phase where they want to see that continue to grow in the coming months. But for now, it's going to go ahead and earn a big check for fundamentals. When we look at the sentiment, you're looking at what the stock's doing in the news and how it's turning heads by creating its own chips. And then we see the bullish rankings from a group of investment analysts, according to S&P Capital IQ, giving it a buy rating. So overall, the sentiment for the stock is bullish. So it gets a big check mark today as well. And then the price chart, that's actually going to get an X today because of the uncertainty and how it's just kind of stuck in between those key levels, the 200-day moving average, the long-term support line. But until one of those are broke, it's hard to really be bullish or bearish. due to the chart, so it's going to get an X today because I can't recommend it based on the chart. But based on the fundamentals and the sentiment for the stock, it's actually going to end up on our bank it list for today. So Cisco is a stock that you can bank on moving higher from here. Just don't forget the key levels on the chart. We have that long-term green trend line. That's going to be key if you're bullish on the stock, to watch that key level. Watch for shares to stay above that, because if they break below that, I don't care what the fundamentals or the sentiment says, it's a stock that's going to head lower if it breaks below that long-term green support line. So keep an eye on that if you have exposure to Cisco, or if you're interested in it, or if you want to buy it now. Keep your stops just below that green support line, because when it breaks below that, it's time to get out. Now, before I sign off, I just want to remind you that you can scroll below the video and you'll find a link that will tell you how I collect income from the stock market and how I do it on a consistent basis. We'll tell you all about it. Just scroll below and click the link. And I also link back to my recent Bank It or Tank It on Under Armour. So you can scroll below. You'll find a link to that, because Under Armour is following the exact move that we laid out in my Bank It or Tank It a few weeks ago. We expected it to move higher in the short term, and that's exactly what we've seen. But I don't expect that to last for long. So check out that Bank It or Tank It on Under Armour to figure out why I don't think that the shares are going to continue to go higher from here. And I actually expect the stock to pull back and very soon meet a strong resistance level and to dip lower in the coming weeks. So thanks for tuning into my video today. If you enjoyed the content, just give it a thumbs up to let me know. And don't forget to subscribe. And you can always scroll below and leave me a comment with the stock that you want me to take a look at in the coming weeks. And I'll be sure to feature it in an upcoming Bank It or Tank It. So until next time, I'm Chad Shoup. Let's go get it.